So, let's peel back the layers on General Motors' latest earnings report. We're going to uncover a massive, multi-billion-dollar pivot that is completely redefining the company's future. You know, if you just looked at the headlines, 2025 was an absolute blockbuster year for the auto giant. Seriously, the company was posting these incredible results, and Wall Street was loving it. I mean, check this out. GM delivered a massive 54% total return to its investors. That's a huge signal of powerful performance and some serious market confidence. And it wasn't just the stock price. We're talking a staggering $12.7 billion in adjusted operating profit. By almost any measure, this wasn't just a good year, it was an exceptional one. And you can hear that confidence coming right from the top. CEO Mary Barra was praising her team for navigating a really complex market to get these results. But, and this is a big but, here's where the story gets really interesting. See, because underneath all those fantastic headline numbers, GM was quietly making a huge and very, very expensive course correction. They were hitting the brakes on that all-electric future they had so publicly promised. And this gets us to the heart of the matter, a massive strategic pivot away from their original electric vehicle plans, a pivot that came with a really hefty price tag. This is the key question, right? GM had basically bet the farm on a super fast transition to EVs. So what on earth happened to force such a dramatic change of plans? Get ready for this number? $7.6 billion. That's how much GM took in EV-related charges and write-downs in just the second half of the year. It's a monumental figure that just shows you how big the shift really was. Okay, so to really get this, we have to talk about a little accounting term of write-down. Basically, it's when a company admits that an asset they own, like a factory or equipment, isn't worth as much as they'd been saying it was on the books. So why the huge write-down? Well, it really boils down to three key things. First, people just weren't buying EVs as fast as GM expected. Second, they pulled the plug on their BrightDrop electric van program. And third, they decided to switch a plant that was supposed to build EVs over to building their super popular gas-powered trucks instead. You can see this as a complete 180 in their thinking. The old plan was all about speed, going all in on EVs. The new plan, it's way more practical. Give people the gas cars they want right now, and take a slower, more careful approach to building out the electric side of the business. So GM's in a tough spot. What's their game plan? Well, it's got two main parts. And part one is pretty simple. Double down on what's making money right now. And for GM, that means gas-guzzling trucks and SUVs. And let's be clear, GM has some absolute powerhouses to fall back on. They're number one in full-size pickups and full-size SUVs, which just happen to be America's favorite and most profitable vehicles. Plus, they had a record year for crossovers and grabbed their biggest piece of the US market in a decade. This is their cash engine. And listen to this quote from Mary Barra's letter to shareholders. It is so telling. What she's really saying here between the lines is that the government is easing up, giving them more freedom to build the gas-powered vehicles that people are actually buying today. But don't think for a second this is just them running back to the past. Nope. Part two of their strategy is all about the future, and it's a huge bet on something with way higher margins, software and technology. So think of it like this. They're easing off the accelerator on EV production, but they are absolutely flooring it when it comes to software. They see this giant opportunity to get recurring revenue from services, basically turning the car into a money-making platform. And if you want proof of the potential here, just look at their Super Cruise hands-free driving system. The number of subscribers basically exploded, jumping almost 80% in a single year to over 600,000. That's exactly the kind of profitable, sticky business they're chasing. And this isn't just some small side hustle. GM is projecting they'll have about $7.5 billion in deferred revenue from software and services by the end of 2026. This is a core piece of their future. All right, so where does all this leave GM? What does the road ahead look like? Well, they're setting up 2026 to be a year of balancing the profitable present with a very uncertain but still electric future. And you can see this balancing act in their financial forecast. On one hand, they actually think profits are going to grow in 2026 to somewhere between $13 and $15 billion. But on the other hand, they're also bracing for a big hit from tariffs. We're talking up to $4 billion in taxes on imported stuff.
So, the big takeaway here is that GM is basically walking a tightrope. They're dealing with the huge costs of this EV pivot, they're navigating global trade problems, and they're trying to do all that while still funding the next generation of cars.
And that leaves us with the big, multi-billion-dollar question. This dual strategy, milking the cash cow of gas trucks today to pay for a slower, more careful move into EVs and software tomorrow, is it a masterstroke of adaptability, a really smart response to the market? Or is it a massive gamble that could leave them in the dust if the EV market suddenly takes off again? The answer to that is going to define the next chapter for this American icon.